All right, welcome. Today, we are going to crack the code on what is truly the universal language of business, financial accounting. Now, I know it sounds a little intimidating, but trust me, by the time we're done here, you'll get the basic grammar that every single company, from your corner coffee shop to a massive tech giant, uses to tell its financial story. Okay, let's get into it. So let me just start with this question. How do you really know if a business is healthy? I mean, is it just about the money coming in, or is there, something more going on beneath the surface? That is the fundamental question that financial accounting was invented to answer.
It really all boils down to one simple, powerful idea: balance. It's just like in our own lives, right? We're always trying to balance the good stuff and the not so good stuff. Well, a business is doing the exact same thing. It's in a constant balancing act between what it has, its resources, and what it owes, its obligations. This idea of balance, it's the key to, well, everything that follows.
And that leads us right to the absolute bedrock, the golden rule of business finance. It's called the accounting equation, and it is the one unbreakable law that makes sure everything always, and I mean always, stays in perfect equilibrium. Okay, first up in this equation, assets. This is just a fancy word for all the valuable stuff a company controls. We're talking about the cash in its bank account, the products sitting in the warehouse, the computers, the trucks, anything that has value and can be used to make more value in the future. All right, on the other side of the coin, you've got liabilities. So if assets are what a company has, liabilities are what it owes to other people. This is the money it got from outside sources, like a loan from a bank or what it still needs to pay its suppliers. These are its debts. And that brings us to the last piece of the puzzle, equity. This is the owner's slice of the pie. Think of it this way. If the company were to sell off all of its assets and pay back every single one of its liabilities, whatever is left over, that belongs to the owners. That is equity. Okay, so let's put it all together. This is where it all just clicks. Assets must always equal liabilities plus equity. Everything the company owns on the left side of that equation has to be claimed by someone, either the lenders and suppliers on the right side or the owners, also on the right. And listen, this isn't just a nice idea, it's a mathematical law. It has to balance. Always. So you're probably wondering, how on earth do you keep this thing balanced when businesses are so chaotic, with money flying all over the place? Well, the answer is this really elegant, almost genius system called the theory of double entry. It's the engine that keeps that accounting equation perfectly true no matter what happens. Now, this quote really hits the nail on the head. For every single resource a company uses, accountants call that an application. There has to be a source for it, an origin. You can't just have something appear out of thin air, right? The resource, the money, it had to come from somewhere. It was either borrowed, or an owner put it in, or it came from cash the company already had. I love this way of thinking about it. Imagine you've got two big buckets. The applications bucket on the left is where you put all your assets. The origins bucket on the right is for your liabilities and your equity, where all the financing came from. Every single time something goes into one bucket, something of the exact same value has to have come from the other. They've got to stay perfectly level. All right, so the theory is cool, but let's get our hands dirty. How does this actually work day to day? Well, accountants use this super simple but really powerful tool to track every one of these two-sided transactions. It's called a T account. Let's see how it works. To make this really stick, we're just going to walk through a quick story about a tiny company. We'll look at where it starts, see a couple of basic transactions, and then check out the final picture. So here we are, day one. The company has one asset, $110 in cash, and that is perfectly balanced by where it came from, a $10 debt, which is a liability, and $100 from the owner, which is equity. See? 110 on the asset side equals 10 plus 100 on the other side. Perfect balance. Okay, now something happens, a transaction. The owners decide to invest another $8,000 in cash. Look at how the T account captures this perfectly. The cash account, that's an asset. It goes up by $8,000. That's our application. And at the exact same time, the capital account, that's equity, also goes up by $8,000. That's the origin. Both sides of our main equation just went up by the same amount. The balance is still perfect. So after that transaction and a couple of others, like buying some inventory, we get to our final snapshot. The T accounts have done their job, tracking every little change. We can see the new final totals for cash, merchandise, debt, and capital. And guess what? If you do the math, our golden rule, assets equal liabilities plus equity, is still holding strong. It works. So, why do we go through all this trouble, all this careful tracking? It's not just for fun, I promise. The entire point is to create a few key reports that tell the company's whole financial story. These are the financial statements. And there are really three big ones you need to know. First, you've got the balance sheet. Think of it as a photo, a snapshot in time of that big accounting equation. Then there's the income statement. This is more like a movie. It shows you the action over a period of time, telling you if you made a profit or a loss. And finally, the cash flow statement. This one just follows the money. Where did cash come from and where did it go? Simple as that. And this right here is the big aha moment. This is where you see how the whole system is this beautiful interconnected machine. The cash flow statement explains the change in your cash, the income statement explains the change in your equity from running the business, and both of those movie reports feed right into the snapshot that is the balance sheet, creating one complete, logical, and perfectly balanced story. So, there you have it. You now have the key to the kingdom. You can speak the language of business. The next time you look at a company's financial report, or hey, even just think about your own personal finances, you're going to see it in a whole new light. You'll see the balance, the two sides to every story. So the only question now is, what stories are the numbers all around you waiting to tell?